So yeah, so this is the structure of the exam. Okay, so this is how they are going to be. The 5 marks questions will be put in this, or will be examined on these areas. Consolidation will be 25 marks. Question 1 will be 20. The last 5 marks will be under question number 4. That will be theory, which is always what difficult there. We also come to the financial reporting standards. The question 2 will be financial reporting standards. Then the question 3, the first part will be financial reporting standards for 10 marks. Then you have the ethical issues. You also be looking at issues of ethics. Okay, the ethics, since it's theory, it can help you to pass the exam. So we just have to master your the principles very well, and how to recommend certain activities when you are being asked to. Okay, this is going to be 10 marks. Even if you don't understand the question, please, it will always be about the ethical issue. So you can just look and see whether you can find any issue about integrity, objectivity, and any issue. And also, if you identify the issue, is there any financial reporting implications of whatever the person is doing? Maybe it might be like inventory. The standard says that inventory should be measured at lower of the cost and net valuable value. And the person is now valuing the inventory at a higher cost. So what would be the financial implications? We have to also talk about. Then we have the specialized transactions. The specialized transaction is going to be issues of business valuation. So a company, a shareholder want to dispose of each shareholding in a particular company. So how do we know the value of the shares? How do we know the amount that he should dispose the share for? So we have to do the business valuation. Mostly it is the valuation of equity. Okay, so we'll be using the net assets method, the price earning ratio, dividends, you know all those things already. Then we come to a company that is struggling. We come to capital reorganization issues. A company is struggling, like Cocoa Board. Okay, they are struggling and they want to go back to profit-making ways. So they want to now cut off non-profit making divisions or operations, or they will be deciding whether to close down the business and for some time, or they want to close down, dispose the assets, and settle their debt or something like that. So we'll be looking at issues of the liquidation, interpretation of financial statements. Okay, you all know this is all about the ratio analysis and the common size. Okay, so they will give you a financial statement and they will ask you to measure the performance of that particular entity, either in a relation to the industry or in relation to another competitor or a different entity, or in relation to the past performance of the entity itself. So they will be asking you to calculate certain ratios and also write a report on that. Please don't forget the format of the report writing. It will give you like maybe 2 marks over there. Okay. Then we don't want to waste time. Okay. We are going to be solving 2 questions. Okay. One on complex group structure, which is going to be the vertical one. We have done both the vertical and the D shape or the mixed group already. So we are going to be solving question on the vertical today. Then we also solve a question on step acquisition. Then tomorrow we look at disposal of foreign subsidiary and cash flow. All right. So this is the question. All right. We know already. If you have a corporate reporting question, which is group accounts, okay, whatever be the case, you are going to be adding the financials of 2 entities as if they are a single economic entity. So you are going to be putting their figures together. You have to know that always the first entity is the parent. So just go to your requirements and see what they are asking you to do. They are asking you to prepare a statement of no, this is not this is a question. Oh, now how do we prepare a statement of comprehensive income here? No, cannot be possible. So I didn't check that one. It should be statement of financial position, the statement of comprehensive income. This is statement of financial position. So this cannot be possible. Okay. So this is about statement of financial position. Okay. So the first thing that you have to do is that, okay, you'll be adding some of these figures to the parent figures. So just go and prepare your statement of financial position. So let's go there and have our statement of financial position. And that should be in the name of the Aboko B or something like that. Okay. So we have the Aboko B. Okay. Group. Okay. So group consolidated statements of financial position as at 30 April. So let's check the date there, 30 April. Okay, 2021. So you have the 2021 there. Okay. So we have the assets here. Then we have the non-current assets. Okay, so you check whether the current asset is given to you as one item. Okay, since the current asset is given to you as just an item, it means that having just a currency, just one column for the currency will be okay. So we look at our PPE there. Okay, if you write a PPE in the exam, they will pick it for you because PPE is something that we all know. PPE NCI is something that we all know. So there is no other PPE again. There is only in property, plant, and equipment that we call the PPE. So what is the parent figure? 596,330. So we have the 596,330. Since we are here to read the footnote to know the subsidiaries, let's just bring the parent figures and be adding up after we start reading the footnote. So what will come there? We are going to be having investments. So the investment is likely to be the parent amount that they are paying for the shares in the subsidiary. So just leave the investments. There might be other investments. So we say that you always have to reconcile the figure for the investments. So the parent might be adding the amount that they are paying for the shares of the subsidiary plus the parent having any other investments. We might be buying the equity instrument or the debt instrument of a different entity, which is going to be given as a financial asset. That can also be part of the investment. So for now, we are going to leave the investments and we can have goodwill over here. Okay, there will be a goodwill. If there's no goodwill, just put dash there and move on. So let's come to our current assets here. So leave a space because you are here to read the footnotes. There might be other issues coming in there. What is their current assets? Okay, their current asset is
8732.
Okay, 320. Okay, so let's go to equity and liabilities. The equity items, it should always be the parent items because the subsidiaries one will be part will be consumed in the purchase consideration and the remaining figure will be the goodwill. But the one that they are going to be having, the equity items after acquisition will now be shared among the parent and then the subsidiary. So the equity items before we acquire them will be consumed into the investment. We are going to cancel the investment against that one. That is why we don't bring the investment into the statement of financial position because the investment will cancel the equity items at acquisition. The difference over there is the goodwill. Okay. After that, they are going to be making profit. That will be shared among the parents and then the NCI. So we don't bring the subsidiary equity items. So we have the stated capital. What is the stated capital for? The equity shares for the parents, 100,000. So we have 100,000. Okay, so let's have the 100,000 in a bracket like this. Then we have their return earners. The return earners, there might be addition and subtraction. So we always do workings for this one. Before, if you're adding, a lot of adjustments will become it. That might be plenty, and that cannot cover the what the space for you. So you always have to do workings for that. We only add the ones that the addition, like the space, the figures that we are going to be adding will not be that much. Okay, so we have the other, I'm sure they have other components of equity or other reserves. Okay, so other reserves will be the revaluation and those fair value gain of instrument classified through other comprehensive income. So we now have the NCI, which will be the non-controlling interest. So we have the NCI to be non-controlling interest. Okay, so we also do workings for that. Let's come to the non-current liabilities. We have just one figure. Okay, so giving you one figure is important, but for the purpose of ticks, it's not important, or it's not good. Okay, for the purpose of you taking ticks, it's not good, but for the purpose of you moving fast, it's good. Okay, so we have the non-current liabilities is 150,000 for the parent. Okay, so let's come to their current liabilities. So what is the parents' liabilities figure for the parents? 43250. Okay, 43250. So from this place, you can now start with your workings. The first one will always be the group structure. So the group structure will also give you some ticks. So do the group structure nicely. You can even do it in a table form. We don't have any format for the group structure. The only thing is you should be able to show the parent holding, the NCI holding. That is it. Show it clearly. The acquisition date and the post-acquisition date and then the reporting date. Just show those ones clearly. That is it. You should be able to show whatever you are going to be doing. You should be able to show the parent percentage holding. So that the statement that you are preparing, what is the parent percentage? Okay, in each of these subsidiaries. So what is the group structure? So let's start reading now. Let's start reading now with the footnotes. Okay, without that also, you have to determine, this is statement of financial position. You have to determine the profit that they are making after the acquisition so that you can share it among the parent and then the NCI. So we can come to the net assets, which is purposely done for finding post-acquisition profits. So we can have the net assets of the subsidiary. We are going to be having two subsidiaries this based on this question. It is not likely that in corporate reporting exam they will give you parent with associate. It is not possible. It is not likely. Not that it's not possible. Okay, it is going like the probability of that happening is very low. So we have the net asset for the two of them now. Okay, so after that, we come and write their name. Okay, so you can also start with your goodwill. You are going to be calculating goodwill. Okay, so we have the calculation of goodwill. You can just create a reasonable column for this. Then you count to, maybe the goodwill is going to be 2. You are going to calculate 2 goodwill. So you count to your non-controlling interest here. Okay, so you find your total non-controlling interest. So non-controlling interest. Please open this space for them. As soon as you get these figures, bring them to wherever they belong. Then you move on. Let's come to the next one will be group return earners. Let me look at the space. Okay, this is okay for this one. Group return earners. Okay, so the group return earners. Okay, so group return earnings, we can get the figure. So the parent is It's a company that is trading on their own. So they will have their own profit before they will add any share they are having. So the parent profit will always be given to you, the reporting figure. So 87, we have the 875,400. Okay, so we can leave a space now and go to maybe a lot of items will be coming there for this. So you can now come here and have your 6, which will be a group other reserves. The parent is having other reserves. So whatever that is coming from the other reserves, the parent will take each share here. So let's look at that. What is the parent figure in the statement? I'm sure that is 15,000 for us. Okay. All right. So after this one now, then you just start reading. You start don't even start adjusting anything. Okay. Start to identify the subsidiaries. So as soon as you identify a company as a subsidiary and there's no issue of disposal, then it means that you have to add their figures to the parent figures. So Auntie Agnes, are you there? Take the additional information for us now.
Additional information A.
All right.
Abokobi acquired 80% of the equity shares of Dodowa on 1st May 2018 at a cost of 350 million Ghana cedis. At this time, the retained earnings balance of Dodowa was 255 Ghana cedis, 255 million Ghana cedis, and the
Okay.
fair value of the non-controlling interest was 80 million Ghana cedis. As 1st May 2018, it was determined that land in the books of Dodowa with a carrying value of 100 million Ghana cedis had a fair value of 135 million Ghana cedis.
Thank you. So with just this particular note, you can get like 10 ticks from this particular note. Okay. You see, for financial corporate reporting, the consolidation, okay, the maximum ticks that you need to get a 20 marks is 80. Okay, as soon as you are able to get 80 ticks, they will give you all the 20. Maybe the ticks might be more than 80, but as soon as you are going to be getting 80, they will give you all the 20 marks. Okay, so what is the target now? What is our target now? So just do your work and make sure that you are closer to the 80 ticks. Okay, so you can get the higher marks over there. The maximum number of ticks that you need to get the 20 marks is 80. Okay, so that will be, I'm sure a tick is 0.25 or something like that. Okay, so within this one, we can get a group structure. Okay, we can get a group structure, we can get acquisition dates. We can even get the purchase consideration for the calculation of goodwill. Okay, so we can also get the purchase consideration for the calculation of goodwill. We can also get the NCR figure over here. We can also start doing the net asset from this place. Okay, let's look at the figures that we can get straightforward. We can get our purchase consideration. They say they are paying how much? 380 million. Okay, so since they are paying 380 million, it means that they have 3 zeros at the top. So let's put the 3 zeros there. So, okay. So let me just come here and have, okay. So goodwill calculation, we do it for Dodowa first. So let's come to Dodowa. So we have their purchase consideration. Okay. So 350,000, keeping 3 zeros. Would that be 350? So 350,000. Okay. Can we also pick the NCR straightforward from that place? Okay. So we can pick NCR there. Okay. That will give us Dodowa. Okay. How much is the NCR figure?
80.
Is 80. So that will give us 80,000. So we have the 80,000. Okay. Let's start with their net assets now. So we can start with the net assets. Okay. So we have at acquisition. at reporting, and we come and find a
Sir.
different. Yes, please.
The 80,000 NCI, where did you get it from?
It is in a question there.
Oh, okay. Thank you.
All right. So let's come to what are we going to be having? We are going to be having the equity shares. Okay. So the net asset is calculated from equity side. So we have the equity shares. Okay. So what is their equity value? The closing figure will be the same as the opening figure, because there's not going to be any new issue of shares. We want the parent to still be maintaining the 80%. But if you are issuing new shares, it means that the parent will not be having 80 again. But we want the growth structure should remain constant at the reporting date. So the shares at acquisition will be the same as the shares at reporting. That will be 750,000, which is a value 75,000 rather. Okay. Let's come to retained earnings. What is their retained earnings at acquisition? Retained earnings at acquisition. At this time, the retained earnings balance of Dodowa was 225 million. So 255,000. That was the 225,000 at acquisition. So 225,000. Okay. Reporting is how much? Let's pick that reporting figure. Their retained earnings at reporting is what?
525. 500.
Okay, so 525, 500. Okay, there's some fair value adjustment over there, isn't it?
Hello, sir.
Yes, please.
Please, the return is at acquisition is 255.
Okay, but I wrote what?
225.
Oh, sorry. Okay, thank you. There is a fair value adjustment there. What are they saying there? At 1st May 2018, it was determined that the land in the books of Dodowa with a carrying value of 100 million had a fair value of what? 135 million. So what is the value of the land in their books? What is the value of the land in the books, in the financial statement that we have here? What is the carrying value of
100 million.
100 million.
100 million.
But the value is supposed to be what?
135.
Okay, so it means that the land has increased by what?
85,000.
Okay. If asset is increasing and liability is constant, what will be the effect on the net asset? The net asset will also be increasing, isn't it? So we have 35,000.
Exactly so.
Okay. But this one, you can see that land is we assume that the land is going to be freehold item, so no depreciation. Sometimes it can be a different item that will be depreciated. So you calculate the depreciation portion on it and take it, because we are doing this at the what? At the acquisition date. But we are incorporating this at acquisition date, but our reporting date is different from the acquisition date. So it means that we have used some portion of the land. So we have to take that portion, which is the depreciation. We cannot go and start what? Consolidating the Dodowa also and add the 35,000 to their assets. So their PP is what? 355. So we have 355. 370 plus the increment of 35,000. Are we correct?
Yes.
Okay. Let's count to their current asset is 75,000. So current asset is 75,000. Okay. Let's go to their non-current liabilities. The equity item will be consumed there. So their non-current liabilities is what?
Ben,
Yes, please.
75,000. It's 56,550.
Oh, sorry. So 50, 56, 550. Okay. Let's go to their non-current liabilities. How much is the figure there?
80,000.
Okay, 80,000. And their 80,000 plus 31,420. Okay, so we have done the consolidation for them now, and I don't think so. The purchase consideration included in the investment for them is what? 350,000, isn't it?
Yes.
Okay. Okay, but what is going to happen now is that we are going to be having a remaining balance of 150,000 over there. We have to come and look for it and what adjust that particular one also. So we have done all the necessary things, the purchase consideration, the return earnings, the non-controlling interest, the fair value adjustment. B. Okay.
B.
Yeah.
The balance on other reserves relates to movement in values of investment measured at fair value. 12 million Ghana cedis of which relates to investment in Dodowa.
Okay. So what are they saying? It means that the parent is carrying the investment in Dodowa at what?
At fair value through a component.
Okay. So, but if you're having control over a particular company, do you have to apply the principles of financial instrument, IFRS 9?
No.
Okay. So I'll go and I will send the investment there now. Then we adjust those ones against them. So let me bring the investment here so that we can now reconcile the investment. So I'll have 500,000. Then I'll subtract the 350,000 here. Okay. But let's come here. Okay. They are saying that other reserves, 12 million relate to what? The investment in Dodowa. Okay. If this is other reserves, which means that this is an income. Okay. If we are having 12 million in other reserves, this 12 million will be included that way. If your asset is increasing, the fair value is increasing, would the value of the item be increasing or it will be reducing?
To be increasing.
Okay. So it means that the 12 million over here is being captured in the investment over here. So we don't have to even fair value this. We go and take the 12 million, which is 12,000, and we go to our other reserves. So we have the reversal of fair value gain relating to Dodowa. That should not be recognized. So we go and take that one out. We are having control, so we have to account for this transaction using the principles of IFRS 3 and also the IFRS 10. No, the only time that you can account for the investment as a financial instrument is where your holding is less than 20%. Even if your holding is more than 20%, you have to use IAS 28, investment in associate. Okay, so we only use the financial instrument if the investment is just a mere investment, which is less than what? Less than 20%. But we are having 80%, so that is control. We cannot carry that particular investment at fair value. So we have canceled that now. Let's go to the 350,000 over here. So Abokobi acquired 80% of the equity shares at a cost of 350 million. So that is the 350,000 there. Okay. So let's go to C.
C.
Yeah.
Dodowa acquired 70% of the equity shares of Oyarifa on 1st May 29 at a cost of 435 million Ghana cedis. Of this cost is payable on 1st May 2022. Dodowa has recorded only the cash consideration. Appropriate discount rate is estimated at 10%. At this time, the retained earnings balance of Oyarifa is 285 million Ghana cedis, and the fair value of the non-controlling interest is 175 million. At 1st May 2019, it was determined that the plant in the books of Oyarifa had a fair value of 20 million below its carrying value. The plant is being depreciated over its remaining life of 10 years.
All right, thank you. So, okay, we have to come and do something over here. So The D will come to the D also there. Okay. So let's come to this side. Okay. So who is acquiring the what? The 70% in Oyarifa? Is the subsidiary of
Odoa.
Abokobi, isn't it? Okay.
Mm.
So we are the what? We are the owner of what? Of Dodowa. Okay. Abokobi is the owner of Dodowa. So if Dodowa is now having a control over subsidiary, it means that we have to consolidate the Dodowa together with what? With the Ayarifa, because a subsidiary that is wholly owned or partially owned by a different company cannot consolidate. Okay, so the consolidation will be done by the parents now. So the parent is not going to be having 80% of the 70% control that Odowa is having over the Oyarifa. So for this reason, since Oyarifa is a subsidiary of Dodowa and we are the majority owner of Dodowa, since we are going to be consolidating Dodowa, we have to consolidate each subsidiary in addition. So Oyarifa will now become a subsidiary. But the consolidation will start from what? Will start from 1st May 2019. We acquired the Abokubi acquired the Dodowa on 1st May 2018, but at that time, Dodowa has no control over what? Oyarifa. So consolidation will start from the time that Dodowa has control over the what? Over the Oyarifa. So you can, let's now go to the group structure proper. Okay, let's go to the group structure proper. So the group structure right now will be having Abokubi. Okay, so Abokubi is having 80% here in what? In Dodowa, isn't it? Okay, and Dodowa is having 70% in Oyarifa. Okay, so you can calculate your effective control. Okay, so effective interest. So effective interest of the parents, everything that Dodowa will be having over here, the 70% of everything Dodowa will be having here, the parent will have 80%. So we have 0.8 multiplied by 0.5, 0.7. That will be the parents' share of everything that will be happening in Oyarifa. How much are we getting?
56%.
Okay. So 56%. So the non-controlling interest in Oyarifa will be 44%, isn't it?
Yeah.
Okay. So you can do that. We come to their net asset also there. Then we can now move on. Okay. So let's come to their net asset first. Let's kill that one before we move on. Okay. So they have been acquired at what? 435. But you can see that this is going to be for cash and what? The consideration are two. We have cash and which one?
Deferred. Is it deferred obligation?
Yeah,
Deferred consideration.
Deferred consideration. Yeah.
Okay, deferred consideration. But let's come here. So we are acquiring these people at a cost of what? 435. Okay.
435.
But they are saying that 100 million of that cost, 100 million of that cost is for cash. So what will be the portion that is for cash?
335.
Okay, so this is supposed to be 335. So why the investment under Dodowa is okay? We come and know why. Maybe there might be a reduction somewhere. Something might happen and they will write it off against this one. So we come and reconcile that one later. Okay, but we know that. Yes, are you calling me?
There was a discount.
No, there's no discount. It's we don't purchase and if you are they are selling to you at a discount, you only recognize the discount figure. So they will not tell you that the cash is 335. So the cash that you pay should be 300,000. But I'm sure something might be happening somewhere that will reduce that particular one to the 300,000. So we reconcile that later. So let's come to goodwill under Oyarifa. Let's come to the goodwill under Oyarifa. Okay. So let's come to the purchase consideration. Okay, the purchase consideration, we have to do workings for it. Okay. And the parents will have the owners of Dodowa is the parent and then the NCI. So whatever they are going to be doing, they will do it in the name of the parent and then the NCI. So whatever they are doing, parent is having 80%, NCI is having 20%. So the purchase consideration will be shared among the parent and then the NCI. So the parent will bring only its portion for the goodwill calculation. So let's go and do the total purchase consideration for these people. Then we take the parent share of that. Okay. So let's come here and do maybe purchase consideration for the purchase consideration in Oyarifa. Okay. So we are going to be having cash of what?
68.
Okay. Cash of 335. Is that correct?
335, yes.
Okay. So that will be 435 minus the 100.
100.
Okay. So we're having 335,000. Okay. But
Are
100,000.
we not applying the 80%?
No. We want to find the total before we apply the parent share on it. Okay. So we have to come here. When are we paying the 100,000? 100 million.
In 2022.
So how many months from now? The first May.
It's a year.
That will be how many years? 2020 is 1
One.
year. 2020 is
Yeah.
1 year. 2021 is another year. 2022 is what? Will be
3 years.
3 years. So we are paying this in 3 years' time. Okay. So the 100 million will be paid in 3 years' time. Okay. The question is if we should have cash and pay these people today, it will not be the same value. So we have to find the interest component of that. So we come here and have our deferred consideration. Okay. So we have deferred consideration of 100 million divided by what is the
1.25.
what is their cost of capital?
10%.
5%.
Okay, so 10%. So you can have 1.1 exponent 3. Okay. So what are you having? Or if you like
75.13.
75.13. Okay, what will happen is that let's find the discount factor to 3 decimal places. Okay, 1 over 1.1 exponent 3, 3 decimal places so that we see what we can get. All right. What are we having for the discount factor? 3 decimal places.
I got 0.751.
0.751. Okay, so let's multiply by the 100 now. That will give us,
So that would give me
okay,
75,100.
Okay, so that will give us 75,100. Okay, 75,100. Okay, that's 75,100. Let's total it to know our total purchase contribution are these days.
$410,100.
Okay, the question says that the deferred consideration has not been recognized. Okay, Dodowa has recorded only the cash consideration, so the deferred consideration has not been recognized. So we are paying these people in 3 years' time. So today's value is 75,100. That's supposed to be adding to our non-current liability, 75,100. Okay. The interest component, we come and adjust the interest component later. Let's come to our parent share now. So what will be the parent share of this one? So the parent will be having 80% of the 410,100. 410,100. How much are we getting?
328.0.
328,080.
Okay. So let's come to share of purchase consideration. NCA will be having 20% of that. So we have transferred 20% of the NCA consideration, NCA value to NCA for Yarifa. So that will always be a reduction. So 4,100. Okay. So we are having 3, okay, 3, 2, A0, A0. What would be the NCI share of that?
That'll be 82020.
Okay, so that will be subtraction 82020. Okay, so we come to the interest component later one by one. We are going to be moving. Okay, let's
Right.
come to, yes, senior.
I beg you, I'm a bit confused about the deduction of the this in the NCI, the deduction of this in the 20% of the NCI from the non-control interest. Please, I beg, can you give me some small? It just is confusing me small.
The NCI is now having 20% of their interest in Oyarifa. So they have to pay for that. They have to transfer. They are transferring 20% of their interest in Dodowa to Oyarifa, or the amount that the Dodowa is paying for the Oyarifa, it has to be shared among the parents and then the NCI. Okay, so if the parent is paying, the parent will be debiting their investments. Okay, so the parent will be having an asset. The NCI also will be debiting their value. So NCI is just accounted for like investment in associates. So we have to debit the investment for the parent. That is why we are having the purchase consideration for the parent portion. And what is the NCI portion? They need to bring in cash, but they are not bringing in cash. So what we do is that we transfer that 20% to the Oyarifa. So we are having investments. Now we are contributing to pay. Okay. But you are telling me that whatever money that you have with me, I should take a share of that one and use it to pay for whatever we are going to be paying for some. It means that the value that you have with me will be reducing. So that is why we normally reduce the NCI in the main subsidiaries book. They will use 20% of their money that they have there to purchase the controlling interest or the interest in the Oyarifa. All right. So,
Okay.
all right. So what are we going to be doing? Dodowa has only recorded the cash consideration. Appropriate discount is estimated at 10% at this time. The retained earnings of Oyarifa was what? So let's do the net asset. So net asset for them, we have the equity shares. So we have at reporting, at acquisition first. So we have at acquisition first, and we have at reporting. Okay, so let's come to their equity shares. Okay, what is it?
50,000.
50,000. Okay, 50,000. Okay, their retained earnings is what?
At acquisition is 285,000.
Okay, 285,000. Reporting is what?
435, 750.
750. Yeah.
436, 750.
435.
435.
Okay.
435, 750.
Okay, 435, 750. So we can now consolidate them, isn't it?
Yeah.
So let's come and add their figures. Okay. So let's come and add their asset is 489, 800. So we have 489, 800. Their investment was what? Was 300,000 there. We come and reconcile that one later. What is their current asset value?
My current asset value is 54,800.
54,800. Okay. What is their non-current liability? We have already done the deferred consideration for them. So their non-current liability is what?
30,000.
30,000. Okay. Their current liabilities is
28,850.
28,850. Okay. Let's come to an interesting side over here. Okay. So are we giving the non-controlling interest? Yes, we have the non-controlling interest there. So the fair value of the non-controlling interest was 175. What is the percentage of the non-controlling interest given to you? What percentage is that? What percentage? The non-controlling interest in Oyarifa is what? Is 44%, isn't it?
Yes, please.
Okay. So the non-controlling interest given to you over there is the 44%. So let's go and do our non-controlling interest fair value here in Oyarifa. So Oyarifa will be, what is the figure there?
175,000.
Okay, so we have 175,000 as an addition. Okay, can we add the non-controlling interest over here for the purpose of calculating our goodwill? Can we add the 80,000 to all of them? Okay, so we have the non-controlling interest here to be 175,000. Okay, so we'll do that for goodwill calculation. There's also a net asset, a fair value adjustment there. Okay, what are they
Yes, sir.
saying? At 1st May 2019, it was determined that the plant in the books of Oyarifa had a fair value of 20 million below its carrying value. The plant is being depreciated over its remaining life of 10 years. So what are we, is it an increase or decrease?
It's a decrease.
It's a decrease.
So if it is a decrease, what will be the effect on the asset and then the net asset? It is going to be a reduction, isn't it? All right.
Yes.
Reduction.
Yes, sir.
So we have, okay, let's just say PPE. So we are going to be having a reduction of 20. Okay, a reduction of what? 20. Okay, let's come here. We are going to be having, in PP, we are going to be having a reduction of what? 20. But let's come and do something here. Okay. The asset value that is being reported by this particular company, they have not taken into consideration the fair value adjustment for the Oyarifa. So it means that they are still carrying the asset at what? At their carrying value. Okay. So if at acquisition date, we are saying that the value of the asset has reduced by 20 million, but we are not aware of this. So it means that we have already included the 20 million to calculate the depreciation. So the depreciation has been calculated on this 20 million also. So the question is, what is the component of the depreciation that should be on that? All right. Let's assume that the original value was 100 million. Okay. The original value was 100 million. Okay. What would have been the depreciation for the year? If original value was, the carrying value was 100 million at the date of acquisition, what would be the depreciation that we are going to be charging for the current year? I'm sure that will be only 1 year. What would be the, okay, is 31 April 2021. That will be 2 years. Okay. That is okay. 2 years. Okay. So let's come here. That will be, okay. So let's come here. That will be 2 years. Okay. That will be 2 years. Okay. So assuming that the carrying value at the date of acquisition was 100. Okay. What would have been the annual depreciation every year? Using the 10 years, what would be the annual depreciation every year? Would that be 10 million?
Yes.
Okay. Okay. But they are saying that the value has reduced by 20 million. So it means that at acquisition, the value of the assets should have been what? 80 million divided by 10. So the depreciation should have been what? 8 million every year. Okay. So you can see that we have overcharged a depreciation of 2 million, which is the reduction of the 20 million. So what is the depreciation component of the 20 million that has been charged over the what? Post-acquisition period? That will be 2 million every year. And this is 2 years. The acquisition now is 2 years. So it means that we have overcharged our depreciation every year by 2 million. So 2 years now, it means that 4 million, which is overcharged, has been taken away from the retained earnings of this company. So we need to have what we call the excess depreciation over here. The excess depreciation will come here as 20 million divided by 10 multiplied by 2. This has been taken away from our post-acquisition profit. This at acquisition. So depreciation will be charged after the acquisition. So it will always be in the post-acquisition profit. Okay. It means that we have also overtaken our accumulated depreciation. The accumulated depreciation that has been taken away from the asset is also too much. We have subtracted 4,000 in excess, which is the 4 million. So we have to reconcile that also now. Okay. So let's come to this side. It's a very interesting question. There is an issue on deferred tax over there. D. Okay, let's come here. Let me do this one also before. Okay.
Yeah.
Yes, please.
Won't
100
the
million.
depreciation affect the group return earnings?
No. The depreciation will affect the profit and we will go and share it. So it means that it will be taken away from their profit before we share. So it has already affected the return earnings. But this is not asset relating to the parent. It is relating to the subsidiary. So they are the one that are going to be taking care of the depreciation there. All right.
Okay.
Let's also count to a finance cost over here. So there will be a finance cost element for Dodowa because they are having what? Okay, Dodowa, they're having a purchase, they're having a deferred consideration. So at the end of every year, they will increase this amount by 10%. Okay, at the end of every year, they will increase that amount by 10%. So let's calculate our finance cost for 2 years for them. So we have to unwind the provision. At the end of the third year, you're supposed to pay the people 100 million. But now, the amount that you are owing them, the cash component is 75,100. It means that you are going to be paying interest. So how much will be the interest every year? The interest will be the 10% on this amount. So we have 0.1 multiplied by 7,100. That will be the first year. How much are we having for the first year? Okay. Or if you like, let's just do it like this. Okay. Let's just find the interest together. That will be 0.1 multiplied by 7,100. Okay. And this figure will still increase by 10%. So the 2 years will give us what? Okay. Let me do this one. I'm not sure you get what I'm trying to do. So let's have, okay, we have 0.1 multiplied by the interest for the first year. Okay, what are we having? We are having 710. Okay, that is the interest for the first year. What about the current year now? Okay, the finance cost will be 0.1 multiplied by 1.1 multiplied by 7,100. So the interest will be charged on the opening balance for each year. So this will be, if you want to get a balance, this will be this plus this one. The interest will be added to the principal. Then it is compounding. So the interest will be added to the principal. Then we charge interest on that one again. So let's have that. That will be 1.1 multiplied by 75,100 multiplied by 0.1. I'm getting 8261. Okay, so your total finance interest will be 7510 plus 8261. How much are we getting?
15,771.
Hello, senior.
Yes, please.
Is it not 826.1?
We are doing consolidation for 2 years. This is statement of
Yes.
financial position, not profit or loss.
Oh, okay. Okay.
So you have so the finance will always be at reporting, that will be 15771. Okay. We are also going to be increasing our interest element over here by the finance cost. 771. Okay. So it is Oyarifa who is what? Who is purchasing the item. So they have to be incurring that particular finance cost. Okay. So it will be taken away from their profit before we share that portion. So I'm sure that we are done with that particular D over the C over there. So we don't have anything to do with that again. The D. Auntie Agnes, are you still active?
Yes, please.
Okay.
D. The group deems any fair value adjustments as temporary difference. The appropriate tax rate for tax adjustment is 25%.
So what are they talking about? What are they talking about over here? What are they asking you to do over here? Okay, they are asking you for deferred tax. Okay, so we look for the fair value adjustment now. Okay, let's come to this one. Fair value adjustment for Dodowa. What is the fair value adjustment? What is the fair value adjustment for Dodowa? It is 35,000, isn't it? It is 35,000. The value has increased by 35,000. Is that correct?
Yeah, yes, please.
Okay. So the tax authority will be carrying the asset at cost. You are now increasing the value by 35,000. So this is going to be what this will bring in a deferred tax issues. Okay. So we have to calculate the deferred tax for the fair value adjustment in Dodowa. Okay. Deferred tax, and that will be calculated as 0.25 multiplied by the fair value adjustment of 35,000. Okay. So that will be done at acquisition.
It's the 0.25.
0.25.
0.25. Okay.
Yes. When writing, you wrote 0.2.
Okay. So 0.25. 0.25 multiplied by, okay. So 0.25 multiplied by 35,000. What are we getting?
8,000.
8,750.
Okay. So deferred tax is a liability. So that will be reducing our figure here. Okay. What is the value of the land? What is the value of the asset at reporting? It is same as the 35,000, isn't it?
Yes.
So it means that the deferred tax, there will not be any increase in the deferred tax. Okay. So we still bring that one over here. So let's come to deferred tax A. This place will be full. So deferred tax will be, okay. What I'll do is that let me just add, let's find the deferred consideration at reporting for them. So 75,100 plus 1577. So I will just bring that figure as just one figure. So let me just take this one off here. Okay. So I'll have 90871. Okay. So let's come to the deferred tax. We have to create a deferred tax liability for 8750. So let me go, let's do a deferred tax total and bring the figure there. So we have deferred tax. Okay. So we have a deferred tax for Dodowa, the fair value adjustment in Dodowa. That will be given as deferred tax at acquisition and reporting of 0.25 multiplied by 35,000. So we'll be having 8750. Okay. So let me just bring the 8750 here. 8750 here. Okay. Let's come to Oyarifa. Was there any fair value adjustments in Oyarifa 2?
Yes, a decrease.
So the decrease will be given as well. Is it going to be given as deferred tax asset or liability?
Asset.
Okay. So we have to calculate our deferred tax assets at acquisition and also at reporting. They are going to be two different figures. So let's count the deferred tax assets. Deferred tax assets at acquisition for these people. So at acquisition for Oyarifa. Okay, so we have the Oyarifa here. So the deferred tax assets will be equal to 0.25 multiplied by 20,000. Is that correct? Zero 0.25 multiplied by 20,000. Are we on the same path? The fair value adjustment is 20,000. The reduction is
Yeah.
20,000. Okay.
Yes.
Okay. So we'll be having 5,000, isn't it? Okay. This 5,000 will be acquisition figure. So let's come to the deferred tax asset there at acquisition figure. We are going to be having 5,000. But let's come to the reporting figure now. Would the assets still be, are we going to still be having the reduction of 20,000 again? The reduction, would this still be a 20,000 in the what? At the end of the value, at the end of the reporting date? Will it still be the reduction of 20,000? Think about it. We are having 20,000, but we have reversed what? This 20,000 will be what? Will be consumed over how many years? 10 years, isn't it? The 20,000 will be consumed over 10 years because the useful life of the asset is 10 years. So the 20,000 reduction will now be spread over 10 years. Okay. For the first 2 years, we have already consumed what? 4,000 out of it, isn't it?
1,000. Yes.
So what will be the remaining balance of that reduction?
It will be left with 16,000.
So we have the deferred tax at reporting will be charged on the remaining figure. So reporting will now be 16,000. So the deferred tax assets will now be 0.25 multiplied by 16,000. What are we having?
Hello.
Yes, please.
Please, can you go over the deferred tax for the 16,000 again? I didn't get it.
Okay. So we have a reduction of what? 20,000, isn't it? Okay.
Please.
This reduction, we have what? We have this reduction will be for 10 years, but we are already down to 20 over 10 multiplied by 2. Okay. It means that 4,000, 2 years of the reduction has been reversed to profit or loss. So what is the remaining amount that we are here to reverse, which will be 8 years? It is 10 years. We have done 2 years. The remaining one will now be for 8 years. If every year is 2, okay, so how much will be for 8 years? That will be 16,000. Or just subtract your depreciation that has been reversed from the what? The initial value of 20,000. You will be getting 16,000. Okay, so that will be, how much are we having?
Thank you.
4,000.
Okay, so your deferred tax at this one, asset will be 4,000. Okay, you go to your statement of financial position, you will now have a deferred tax asset here. Deferred tax assets, then you bring, let's say this is working 7. Then you bring your 4,000 as the remaining figure there. Very simple. Okay, you don't have to stress yourself. All right.
Hello, sir.
Yes, now.
Sir, please, can you explain the deferred tax component again from the remaining years? I did not get it.
Okay. Yes, so we are saying that the deferred tax, our asset is reducing by 20,000. Okay. Our asset is reducing by 20,000. Okay. Our asset is reducing by 20,000. So let me just use some figures to explain that one for you. Okay. So let me just say that. Okay. So let me just say that the value of our assets was 100,000. Okay. 100 million.
Yes.
Okay. So this is in our books, the books of the company. So this is for the company. And in the books of the tax authority, let's assume that that is also that will also be, the figure will also be the same. Okay. Because we want to be on the same path. Okay. But our carrying value supposed to be, supposed to be 80. So it has reduced by 20. So at that date, it's supposed to be 80 million. But in the books of the tax authority, it will be 100 million. Okay, we are having a temporary difference of what? 20 million. Okay, which is going to be a deductible temporary difference because our tax base is higher than the what? The carrying value of the asset. We are charging more capital allowance, or we are suffering today. So in the future, we are going to be enjoying. The tax authority will be giving us more capital allowance whilst our depreciation will be over. So we are going to be enjoying. So this will be an asset. So if you want to find your deferred tax asset, it will be 0.25, and that will give you 5 million over here. Okay, after 2 years, you are going to be depreciating this by what? They are all 10 years. Okay, so after 2 years, the carrying value of your asset will be how much after 2 years? I'm having 64 as a carrying value after 2 years. Is that correct? After 2 years, I'm having carrying value to be in the books of the company to be 64. Depreciation every year will be 8 rather. So 2 years will be 16. 16 from the carrying value. That will give you 64. Are we on the same path, senior?
Yes, sir.
Okay. So what will be the tax base of the asset if they are also using 10 years? What will be the tax base of the asset? Would that be 80? After 2 years, would that be 80? Would the tax base, the carrying value of the asset in the books of the tax authority, will it be 80 million? We have done 2 years.
Yes, please.
Okay. So what is the difference? 16, isn't it?
16, yes.
Okay, so your temporary difference at this date is 0.25. Okay, so you'll be having 4. Okay, so to be at the safer side, what you have to do is that you are having a reduction of 20. You have consumed 4 million out of it. So if you have reversed 4 million right now, then what will be the remaining balance? That will be 16. Just multiply by this. Okay, so this is what we have done in a short form like this. Okay, thank you.
Okay. All right, thanks.
Please, if you cannot adjust some of the footnotes, leave it and move on. Don't think about it. If you think maybe the thinking, you have a level of thinking that you are sending to the exam hall. So maybe if you overthink some of the thinking, you will not get them again. So if you see this footnote, the group deems any fair value adjustment as a temporary difference. Okay, the first one you can do it because it is land. There will not be any difference. Okay, if that should also be PPE, we are going to be finding the carrying value of the revalued amount. Okay, we now calculate the deferred tax on the what? On the carrying amount of the asset. It was 35,000. If the asset has been depreciated, so what would be the carrying value at the reporting date? That is what we are going to be calculating the deferred tax on. So we have a deferred tax at acquisition, also at reporting. But this one, the figure is the same. At acquisition and reporting are the same. So we don't have any problem with that particular one. But it's the second one that we are having problem with. So we are done with the deferred tax. We have done the necessary adjustments. I don't think we have to do anything again. E.
During the year ended 30th April 2021, Abokobi sold goods worth 35 million Ghana cedis to Dodowa at a margin of 20%. Dodowa still held 1/5 of these goods in inventory at the reporting date.
So what are they talking about over here? Intra-group trading, isn't it? Okay.
Yes.
Who is going to be having a profit in its statement? Who is going to be having the full profit in its statement?
Children.
Okay.
Aboku.
Aboku. Who is the parent? Okay. But the thing is, are we if you have sent goods to your branch, you can only recognize the profit if all the goods have been sold. So the question now is, were all the goods being sold? Were they able to sell all the goods? They have sold
No.
only 4/5 of the goods, isn't it?
They didn't
Yes.
sell all.
Okay. So they sold only 4/5. So the profit on the 4/5 must be what? Must be recognized. So we don't have any problem with that. So let's come to, let's say, 8 provision for unrealized profits. That will be for Aboko, be the parent. So this will be in the books of the parents. Okay. So let's come to provision for unrealized profits. Okay. So the portion of the goods that has not been sold is 1/5, isn't it?
Yes.
Okay. Multiplied by the total amount of the goods sold is 35,000. We are keeping 3 zeros. Okay. Okay. The 35,000 is a selling price. So you have to apply margin on the selling price. Are we giving margin or markup?
Margin 20%.
So you can just go straight forward. If you are giving markup, you have to change the markup to margin. So what are we having?
20%.
Okay. So what will be the total amount there?
1,400.
Okay. 1,400. Okay. This 1,400, this profit is included in the parent's retained earnings. So we have provision for unrealized profits, which will be 0.2 multiplied by 1/5 multiplied by 35,000. So you can just do your calculation here. They will give you ticks for this one. Then you bring your 1,400 over here. The goods were carried at selling price. Goods should be carried at lower of cost or net realizable value. So we come here and take the 1,400. The goods should be carried at cost, not the selling price. The selling price is higher than that. So we have to go and remove the unrealized profits. The goods will be seen as the goods are still with the parents. If it is still with the parent, that is why we are selling. We are saying that we are not selling all. That's why we are reversing the profits. So if the goods is still with the parent, it has to be valued at cost, or it has to be valued at lower of cost or net realizable value. But the goods is now valued at the higher price, which is the selling price. So you have to now bring it down to the cost of the 7,000 minus the 1,400. So that is the portion for that also. So we are actually done with that figure. Okay. F.
Okay, sir.
Yes, yeah.
The deferred tax now, is it only one figure?
Yeah, we have done all. So it should have been, the deferred tax figure should have been 5,000 minus 1,000 so that you get a 4,000. But we have done a reporting, so we just pick the reporting figure.
Okay, we did some for the other
That is a
value adjustment.
liability. It's a liability. We have liability and assets. So that's why they are all
Oh.
different. Yeah. So the liability has been added to the non-current liabilities. I've added the 8750 to the non-current liabilities here. Okay. 8750 to the non-current liabilities here. So let's move on to, okay. So you will now see where the difference is coming from. Okay. The difference of 35,000 in the investment under Adodowa, you will now see where it is coming from. Let's come here. Let's come here. F.
F. On 1st January 2021, disposed 5% stolen interest for 35 million Ghana cedis. IRFS identifiable net assets as appropriately adjusted for consolidation purposes on this date was estimated at 460 million Ghana cedis. Dodowa has credited the proceeds of disposal to the investment account.
Okay, so you can see that the difference between the investment accounts is that we are paying 335,000. You can see that the difference over here is what? Is 35,000, isn't it? Okay, so it means that the disposal has been credited to this account. So we can now go and non-net of our investment by, so we have 300,000 here. So we can just take the 300,000 out again. Okay, So it means that the 35,000, which is a disposal, is the figure that we are crediting there. So the entry that was done by them is that they debited assets or cash or bank, they debited cash or bank, and they credit the investment. That is the entry. Okay. This one, you see, sometimes they will not give you this figure, but the purpose is not for you to now determine what. Look at the acquisition date. Okay. Look at the disposal date. It's 1st January 2021. They dispose 5%. Okay. So what we have to do is that who are they disposing this to? They have acquired 70%, isn't it? They have acquired 70% of the equity interest in what? In Oyarifa. Is that correct? Okay. They are now disposing what? 5%. Okay. If they dispose 5%, what is going to happen? Are they losing control or they are still having control?
They still have control.
Okay. So the disposal will be between the parent and then the what?
NCI.
NCI. So what we have to do is that at the date of this disposal, we need to find the fair value of the assets. So sometimes you have to do this yourself. You ask yourself, what is the fair value? You have to calculate the fair value at this date yourself. But this one, they have given you this one. Okay. They say the fair value of the identifiable net asset as appropriately adjusted for consolidation purposes. So they have given you the fair value of the net asset already. This is just the physical asset. Goodwill is not part. So you ask yourself, what is the method that we are using to calculate goodwill for Oyarifa? Are we using proportionate method or we are using full goodwill method? Are we using proportionate method or we are using a full goodwill method? Okay. As soon as you are giving fair value of the net assets, as soon as you are giving the fair value of the net assets, as soon as you are giving the fair value of the non-controlling interest, that is a full goodwill method. But if they ask you that, okay, the NCA is being calculated as a proportionate of the net assets, that is a partial goodwill method. So impairment of that will be for the parents, and the goodwill is for the parent alone. But if you are giving fair value of the non-controlling interest, it means that that is a full goodwill method, and the goodwill belongs to both the parents and then the NCI. That is why if you have impairment, it will be shared among the parents and then the NCI. Okay, so we have the net assets at acquisition given to us already. We have to now look for the what? The goodwill for them. What will be the goodwill at this date? Okay. Okay, so we now calculate okay, so let's calculate our transfer to the NCI at this date. So let's look at the transfer to the NCI. How much are we transferring to NCI in terms of this? So transfer to NCI. How much are we transferring to NCI? Okay, so let's come to the net asset at this date. Okay, the net asset without goodwill is 460,000. Okay, it's 460,000. Okay, let's calculate the goodwill for them now. I'm sure we can calculate goodwill now without any stress. We can calculate the goodwill for Oyarifa now without any stress. Okay, let's determine their net assets. So the net asset of Oyarifa, and we determine the acquisition figure and also the reporting figure. So I'm having 50,000 plus 285,000 plus minus 20,000 plus 55,000. I'm having 320,000.
That is correct.
Okay. So let's come to their goodwill calculation now. Let's calculate their goodwill. So their Oyarifa, we are doing this for Oyarifa. So 328080 plus 175,000. We're having 503.
503080.
Okay. So let's come to their net assets. So we bring the total net assets here as 320,000.
183080.
Okay. So that is the goodwill is 183.
080.
Okay. So that is their
Yeah.
goodwill. All right. So that is a goodwill over there. So the goodwill will be added to the net asset because we are using full goodwill method. Okay. So we have the goodwill over here. So we need to come and look for the goodwill that we use is the unimpaired goodwill. Okay. So we now determine what we call the unimpaired goodwill. So goodwill over here will be, let me pick that figure, will be 183 3080. Let's come to the next footnote before this one. Let's come here. G, it is the policy of the group to value non-controlling interest at fair value at acquisition. So that is a full goodwill method. At 30th April 2021, it was determined that no impairment had arisen in respect of the goodwill of Dodowa, but the goodwill of Oyarifa had suffered an impairment loss of what? 8 million. No impairment losses had what arisen in previous periods. So it means that the current year now, the impairment of goodwill is 8 million. This 8 million is for how many months? The 8 million impairment for this current year is for how many months?
4 months.
No. We have acquired them 2 years ago. Okay. But the first year, which is the last year, no impairment has been recorded on this particular goodwill. That's why they are saying that no impairment losses are. So for the current year now, it is 8 million. So this is for how many months? It is for the full year, which is 12 months. Okay, let's come here. On what date are we disposing the 5%?
It's January.
1st January.
So how many months after the start of the current year? Would that be 9 months? Would that be 9 months? Our reporting date, or is 4 months? Our reporting date is 30th April. So January, February, March, April. That is 4 months. So that will be 8 months. Okay.
Yes, sir.
So we find the impairment of the goodwill for 8 months and take it from that. So that will be 8,000. So 8 over 12. 8 over 12 multiplied by 8,000. So the impairment 4 months is for the period after the disposal of the 5%, and 8 months is for the period before the disposal of 5%. All right. What are we having?
We're having 5333.
Okay, so that will be, we are having 5333. Okay, so if you subtract, how much are you getting?
That would be 177747.
Okay, so 17747.
7. So the 7 is 3.
Okay, so what will be our total net assets at this date, at the date of the disposal of the 5%?
So that would be. Is it 460,000? The net asset is it
Yes,
460,000?
yes. 637,747.
637,747. Yeah.
Okay. So let's look at the transfer to the NCI. We are selling 5% to the NCI. So 5% of this will be sold to the NCI. So we have 637,747. So what is the portion that we are transferring to the NCI?
That is 31888.
Okay. So we are having a transfer of 31888.
888.
Okay. But how much are we receiving from the NCI?
887. Yeah, 887.
How much are we receiving from the NCI?
You said 35,000.
Okay. So we are receiving a proceeds of 35,000. Okay. We are receiving a proceeds of 35,000, but we are transferring. So the transfer is 3187. So 3187. Okay. So what will be the difference?
Yes. 3113.
Okay. So that 3113 will be sent to other components of equity of,
Yeah.
of these particular people. So we have 31887. So that will be 3113.
113.
Okay. This 3113 will be shared. It is relating to Dodowa, isn't it? So it will be shared
Yes.
among the parents and then the what? The NCI. So let's go and share that and move on for the two. So the parent will bring a share here, the share of the OCE, that will be 0.8 multiplied by 3113. Okay.
Sir,
Yes, please.
we have a line item for OCU.
The parent
So
will, this is for subsidiary. So it will be shared among the parent and then the what? The NCI. Before this date, none of the subsidiaries had the other reserves. They don't have it. So if we check over here, they don't have it. So that is the item that they have. Unless they like if they should have it, we are going to be adding before we charge now. So NCI will have each share of that. So we have the share of the OCE, share of OCE, that will be 0.23113. This is for Dodowa, so it will be shared based on their controlling interest there. So 0. I'm having 2490.4. Okay, minus 3113. I'm having 622.
623.
Okay, so let's just make it 623 and this one 2490. Okay, so we have 623 and we have what? Or 623 and
2490.
Okay, okay. So we are done with that also now. Okay, we are done with that particular one. We are going to be looking at, so we have done the impairment also now. Let's look for the goodwill for these people. So the goodwill for them will be, so the goodwill for these people will be, we are going to be taking impairment of 8,000 from this figure. Okay, so what will be the final goodwill for Oyarifa? 183,080 minus 8,000. I'm having 175,5080.
Right.
Okay, let's total the net asset for these people also. Let's total the net asset for the Dodowa. What is their net asset at acquisition and reporting?
So at acquisition is 356250.
Okay, 35,000. Okay,
356,250.
250. Okay. Let's come to their reporting figures.
So that one is 610,979.
Okay. 610.
979.
Okay. So we have to find their post-acquisition profit. We will come to, so let's find their post-acquisition profit here. What will be the post-acquisition profit? 610,979 minus what? 356250. Okay.
So that is 254,729.
Okay, 254,729. 4,729. Okay, that will be shared among the parent and then the NCI, isn't it? So
Yes,
let's
please.
come to share of post-acquisition profit. So the share of post-acquisition profit will be for so that will be Dodowa. Okay, so let's do that will be Dodowa. That will be 0.2. In Dodowa, their controlling interest is 0.2. So that will give us 2547. 254729. Okay, what are we getting? 254729.
So we are getting 50946.
50.
946. 946.
Okay, so
50946.
50946. Okay, let's come to the parent share. Okay, the share over there. The parent share will be share of PAP. That will be 0.8 multiplied by 254729. Okay,
So that will be 203783.
203783. Okay, that is their post-acquisition profit. Let's come to the goodwill for. Let's come to goodwill for those people now. What will be the goodwill for? So let's total this, the purchase consideration for the total value of the entity for Dodowa multiplied by 80,000. I'm getting 430,000 here.
Yeah, that's for 30,000.
Okay. What will be the net assets? The net asset at acquisition is
That was the 356250.
356,250. What is the goodwill?
Okay, so that's 73750.
What will be the total goodwill? Total goodwill for the two entities. You add this one and this one. What is the total goodwill?
Okay, so it's 248830.
So that will be the goodwill in your working straight. So you have
248830.
Okay. All right. We are getting closer to the roadside. Okay. So let's come to there was an impairment, isn't it?
Yes,
There was
please.
an impairment in the subsidiary, in the sub-subsidiary, which is the Ayarifa. How would that particular impairment be shared? The first 9 months, the parent will be taking, what is the percentage that the parent will be taking? The first 9 months. The parent will be taking how much in the first 9 months? From the start of the year to 1st January, Dodowa was still having 70%, isn't it?
Yes.
So the parent will have 56% of what? 56% share of the first 8 months. Okay.
8 months. Yeah.
But the remaining 4 months, the parent will be having this share now. Let's calculate that share. The parent will be having 0.8 multiplied by 0.65. Do we agree?
Yes.
Okay.
Yes.
So let's find the share of the impairments. Okay. So let's have the first 8 months. That will be May 2022. Is it 2021 rather? So May 2020 to January 2021. I'm sure that is correct.
Yes.
Okay. So the share of the impairments will be we have
52%.
so 0.56 multiplied by 8/12 multiplied by 8,000. Is that correct?
The 0.8 times 0.65 will give you 52%.
No, we are doing the first month, the first 8 months. It is from January to April, that will be 65.
Okay.
Okay. So what are we having for that? 0.56 multiplied by the 5333. I'm getting 2986.
2987.
Make it 87.
No, the next
Or
one will be, so if you want to approximate, it means that you're approximating 2 times. We only do the approximation only once. So it's supposed to be 2986.5. That is after the approximation. So you can't approximate again. Okay. So the figure after the whole number is 4. So if you want to approximate, you only look at the 4, not the next figure to the 4. The approximation is done only once. So you cannot approximate to have 5 and still approximate to have no. So if it should be 2986.84, then we now approximate by taking the 8 into consideration to make it 2987. But if you approximate, it will be 2986.5. That is the approximation. You can't approximate further again. No. Okay, so let's
then
move.
we had 2986.66. That's right.
I'm having 2986.48, or I'm the one doing the wrong thing. 0.5.
We have 0.6667.
Yeah.
Okay, I'm using the 533. That is why. Okay, so let me just take your own. So I use the approximated figure over here, which is
Okay.
a 33 there.
Oh, okay.
Okay. So I'm sure since we approximated this one, then let's just stick to the 5 that one there. So 5333. So I'm getting 2986. Is that correct?
Yeah.
So the last month, that will be January 2021 to April 2021. Okay. And that will now be, what will now be the new percentage now? New effective control.
52%.
That will be 52. Okay.
Yeah.
Okay. So that will be 52. So share of impairments. Share of impairments will be 0.52 multiplied by, let's just find a difference. 8,000 minus that figure. 8,000
Okay.
minus 5333. I'm getting 2667.
Yeah.
Okay. So I'm getting 1387.
1387.
Okay. So if you add the two, what will be our total share of the impairment for the parents? 2986.
4373.
Okay, 4373. So 4373. So the NCA share will be what? 8,000 minus 4373. I hope we are okay with that.
Yes, please.
Okay. So the parent share of the impairments there, share of impairments, will be 4373. So let's have the NCA share of impairment for NCI. Okay, share
Okay.
of impairment.
Someone is asking a question.
Okay, I'll look at that. So that will be 8,000 minus what? 4373. Okay, so 8,000 there. That will be 3627. Okay, so let's come to, yeah, someone is asking how we got the what?
The 2667.
Okay, so the goodwill is 8,000 for the full year. So the first 8 months that we calculated is 5333. So it is 8,000 and the first 8 months is 5333. So the last 4 months will now be 8,000 minus the what? The figure for the first 8 months. So just subtract the 533 from that, you'll be getting that particular answer also. Okay, so let's come to the share of the profit for the Oyarifa. What will be the profit? You have to know that for the first 20 months, do we agree that for the first 20 months, the parent will be having 0.56 for the first 20 months? Because we are doing
Yes.
two. So for the first 20 months, the parent will be having what? 0.56. Okay. But for the last 4 months, the parent will be having a share of 52%. So let's find the profit for them now, the post-acquisition profit for them. So what is their reporting figure here? So we have 5,000.
Is it 50,000?
50,000, okay. 4,3,575 minus 16,000 plus 4,000. So I'm having 473,
750.
okay, 750. Okay.
Yeah.
You can see that everything over here are all post-acquisition adjustment. They are all 2 months, the 2 years adjustments. Okay, let's come here. The question will always tell you that, okay, the profit for the year to be assumed to accrue evenly. If nothing is being said like that, you still assume that they are being, okay, let's come here. What is the net asset given to us at the acquisition, at the date of the disposal? So we can use this to find our profit very well. So we don't have to do time apportionment. At the time that we are disposing the 5%, what was the net asset given to us?
Yeah, it was 460 million.
Okay. So it means that the net asset at that date was 460 million. Okay. So let's find so this is very simple to find now. Okay. So let's look at net as the post-acquisition profit for post-acquisition profit for Oyarifa before the disposal of that particular one. Okay. What is our total net asset now? What is the net asset at reporting? What is our net asset at reporting for them? I'm sure that is 4,73750. Okay.
Yeah.
So 4,73750. Okay. But the net asset at January was how much? This is April. January was how much?
You said 460,000.
Okay. So what is the increment from January to April now? So what is the increment from January to April?
13750.
Okay. So let's have our net assets at January 1. Okay, that is 460,000. So the difference is what?
13750.
Okay, 750. Okay, so this is the profit for the last 4 months. Do you agree?
Yes.
Okay, so what will be the profit from the acquisition date to the date of the disposal? What will be the profit? Someone should help us with the calculation. It is very simple to calculate. You don't have to suffer. Acquisition net asset is 320,000. But the time that we dispose is what? 460,000. What is the difference between them? Okay. So the post-acquisition profit okay, at January 1. Okay. So let's come to, okay. So that will be, let's look at, we know that the only increase in the net asset is the profit. Okay.
Yeah.
So let's come to the net assets at January. That was 460,000. Okay. But what was our net asset at the date of acquisition? So net asset at acquisition
Was 320,000.
was 320,000. So it means that this has increased up by a certain value to the January 1. Okay. And that will give us 140,000, isn't it?
140,000.
Okay. Okay. So this 140,000, if you check very well, you'll see that your post-acquisition profit will be 153,000. Check this one. Check the total post-acquisition profit here. That will be 153.
153, 750.
Okay. So this 153, 750 is the figure that we have splitted now like this. This portion and this portion. So if you add the two, you'll be getting the same figure. So let's go to the parent share of this profit. So share of so let's just find the share and bring it as the total. Okay. So the parent share of the profit. Let me just do that too. So the parent share of post-acquisition profits for Oyarifa, the first 20 months will be 0.56 multiplied by 140,000. I hope we agree with that. And the
Yes, please.
second one will be 0.52 multiplied by 137.
13750.
Okay, 13750. So 13750. So what are we getting for
78,400 for the first one.
okay 78,400. So 78,400. The last one will give us what?
So the last one will give us 7150.
Okay. So 7150. Okay. So let's come to the share of post-acquisition profits. Okay. In the first 20 months, these people will be having 0.44, isn't it?
Yes, please.
Multiplied by,
Hello, sir.
yes, please.
The post-acquisition profit for the Oyarefa,
Yeah.
the amount is 13750 by 52%. Oh, okay. I think I did 56. Thank you, sir. It's okay.
Okay. So this will be 0.4 multiplied by 140,000 for the first, isn't it?
Yes, please.
Okay. The second one will be, okay. The second one will be 0.48, isn't it?
Yeah, NCL.
Multiplied 13750. So we also bring the transfer to the NCI. I hope you have remembered that particular transfer that we did. Okay. We did a transfer somewhere here, which is 31.
Yeah, 31881.
Okay. So that will come here. Transfer of acquisition of 5%. So that will be 31887. So
Yeah,
31887. So that the NCI will increase. So let's find their share now in the okay.
So the first one will be 61,600.
61,600. Okay.
600. And the second one is 6,600.
6,600. So 6,600. Okay, I'm sure we don't have any further. So we have one footnote to deal with, but let's see whether we have done all the necessary entries that we have to pass. I hope we have reconciled the investment of the 35,000. So we have done that. The NCR2, we have done the goodwill impairment and those ones too, we have done that already. And let's take the last footnote and see how far we can go. Okay. So the share of a POP, the share of impairments. Okay, we have done that already. Let's take the last footnote and see how far we can go. Auntie Agnes,
Eight.
yeah.
On 1st May 2019, Abukobi made an award of 8,000 shares option to each of its 7 directors. The condition attached to the award is that the directors must remain employed by Abukobi for 3 years. The fair value of each option at the grant date was 100 Ghana cedis, and the fair value of each option at 30th April 2021 was 110 Ghana cedis. At 30th April 2020, it was estimated that 3 directors would leave before the end of 3 years due to an economic downturn. The estimate of directors who were going to leave was revised to 1 director at 30th April 2021. No director had left by 30th April 2021. Abokobi is yet to account for this scheme in its financial statements since the grant date.
Okay. So yes, this is share-based payment, isn't it? Okay. Please,
Yes.
you should be paying attention to the footnote. If you go and check, this particular footnote was lifted as a standard on its own. Okay. So you see that we during normal class, we have solved a lot of questions where we have a footnote that is dealing with a standard. They can pick the standard, that particular footnote, and give it to you as a question. So it is very important you pay attention to. So this is about the share-based payments. They say they are here to account for this, isn't it? So this was issued on 1st May 2019. That is 2 years, 2 years from now, or 2 years ago. Yeah, that will be 2 years ago, not from now. Okay, 2 years ago. Okay, Abokobi made an award of what? 8,000 share options to each of its 7 directors. Share options, is it equity settled or cash settled? Whenever they mention share options.
Equity settled.
Okay. So if you see share appreciation will be the cash settled. The cash settled is based on the increase in the share price. So if they see appreciation, it means that the value will be increasing. So that will be cash settled. Okay. At this particular date, what are we doing? The condition attached to the award is that directors must remain employed for 3 years. That is the vesting period. The fair value of each option at the grant date was 100, and the fair value of each option at 30th April 2021 was 110. We use only the fair value at the grant date. Equity, once it is measured, it is not re-measured again. So we are going to be using 100, but the question is, at the end of the first year of the scheme, how many employees are we estimating to be staying during the vesting period? How many employees are we estimating to be staying during the vesting period? At 30.
Oh,
Okay, that will be 4. So we make the provision to cover the 4. So the provision is made for the what? For the vesting period. It's not that we're making a provision for each year, no. If you want to build a house for your kids in 10 years' time, you make the provision for the number of kids that will be there at the end of the 10 years' time. So you are saying that okay, it is likely that 2 of them will not be alive again because we live in a world that you have to visit your grandfathers and stay with them for some time. So you have 10, you are estimating that okay, at the end of the 10 years, 2 will not be there. You cannot be building for the 10 again. You'll be building now for the 8 people that will be there. So you start making a provision as if it is going to be done at the end of. So the provision is made for the number of people that will be there at the end of the vesting period. So let's count to the first year. This is what we are going to be doing. So we count to the first year. They say they are yet to account for this one. So let's count to the share-based payments. Share-based payments. Okay. So the share-based payments, we are going to be having the first year, which is 2020. This has been the thing has been granted on 1st May. So April 2020 is the first year. So let's look at the staff cost. Okay, or the employment cost. So the staff cost will be 7 minus 3. Is that correct?
Yes, sir.
Okay. Multiplied by each person receiving 8,000 options.
Options.
Okay. Multiplied by the amount at the grant date divided by 3. Okay, so we are doing the provision for 3 years. Okay, but since this will take 3 years, it means that we have to spread the amounts over the 3 years. So this is actually for the 3 years. But we can't take it to this year because this amount will be consumed over 3 years. So we divided by 3. What are we having for the first year? Seven minus 3 multiplied by 8,000 multiplied by 100 divided by 3. I'm getting
106,666.
Can we make it? We are keeping three zeros, isn't it? So
Yes.
1067.
Okay.
Okay. So for the first year, how do we treat this? We debit profit or loss and credit what? Other components of equity, isn't it?
Yes, please.
Okay. So this one will be debited to profit or loss, but they are yet to account for this. So it means that this has not been taken away from their profit or loss, and this has not been added to their other reserves. So we go and do that. Let's come to the year now, 2021. Okay, we will calculate the staff cost now. Okay, so you calculate the staff cost. Okay, this one, we are even wasting time. We should have done this for just the current year. Then we take the two of them to other components of equity, and so this has now the provision has now revised to 1, isn't it?
Yes, sir.
Okay, multiply by 8,000, multiply by 100,
100.
by 2, divided by what?
2 over 3.
Okay. We should have ignored this one. If the first one has been done already, we just find a difference. It's a provision, so we just find a difference over there and charge it to profit or loss and other components of equity. But they haven't done any of them, so we can just do the 2 years straightforward. So the 2 years straightforward will be the figure that will go to their retained earnings and also other components of equity. So we should have done only this one, but since we are all learning, that will be 6,000, that will be 8,000 multiplied by 100, multiplied by 2.
We will get 3,200.
Okay, so I'm getting 3,200. Assuming this has been recorded, what we do is that we find the difference. It's a provision. This is not the total provision. So it has increased by how much? We find that particular difference and charge it to profit or loss and take that also to their other component of equity. But since the question is saying that they haven't accounted for any of this since the grant date, so we just do the provision for the 2 years, which will be 7 minus 1 multiplied by the 8,000 multiplied by 100 multiplied by 2 divided by 3. Then we get a 7,200 and just charge that 7,200 straightforward to so we have the staff cost here. That will be expense of 3,200. Okay, so let's have the other component of equity. We have, did we bring the parent? No, the parent share is supposed to come to, it's supposed not to come here. Okay. The share of the OCA. So that was what you are talking about. Sorry.
Yes, sir.
Okay. So we have the share of OCE. That was 0.8 multiplied by 313. That would be 2490. So we bring the staff cost over here, which will be the other component of equity item, 3,200.
Yes.
Okay. Why are we not starting from the grant date? Provision is done at the end of every year. So it will be from 2018 to 2017 to 2020 year. So provision will be recognized at the end of the year. So that is why we are doing it at the end of the year. So the 2020 is the 2019 and 2020 year. 2021 is the 2020, May 2020 and April 2021 year. So by the adding, so this will be, you can't do provision at the beginning of the year, and that is the end. At the end of the day, it will be revised. So it is better you do the provision at the end of the year. You know the actual provision for the year. So this will be 2020 to 2021 year. Okay. So I'm sure we are done. You can now add your figures and you move on. Okay, that is 541. Some people will go to work and all right. So all right. So that is it. You can put your distance together and that is it. Okay. I'm sure that we are able to deal with every situation. It's a very nice question, which is talking about all the possible consolidation items there. So what again? Consolidation, we have to solve like 4 questions. Don't worry. We will still solve the so we can be Sunday too, we can Sunday the time that you are going to be writing the exam, the Sunday before you are going to be writing the exam. So we come and do some standards also. So we have to do standards. The consolidation we have to solve question on step acquisition, because step acquisition and the complex rules are the favorite areas for
The
that's
examiner.
yeah, that's where the number set the question from, especially complex group. Okay, so I want to, maybe I might not be able to solve this question. Someone should read this one. So we solve the complex. We have done a complex group now. We are going to be solving step acquisition and possibly the cash flow. Okay. Auntie Agnes, are you there? Read this one. Let me use this to explain. Maybe we might not solve it. So if you are solving it, you can look at Auntie Agnes, this additional footnote here.
All right.
Oh,
On 31st December 2018, Adams acquired 90% shares of Bauda when Bauda's net assets had a carrying amount of 3,210 million Ghana cedis. The consideration was met by Adamsu issuing 1,080 million of its own shares to the former shareholders. This issue was made 3 months after Adamsu had acquired the shares in Bauda. The share price of Adamsu's shares and Bauda's shares were 3 cedis and 2 cedis respectively at 31st December 2018. However, the share price of Adamsu and Bauda were 4 cedis and 3 cedis 20 pesos respectively at 31st March 2019.
thank you. So the question now is, we are doing share exchange, isn't it? So if we are doing share exchange, we need to find the purchase consideration by multiplying the number of shares by the share price to get the purchase consideration. The question now is, which of the share price are you going to be using? Which of the parent share price are you going to be using? They say the issue was made 3 months after the acquisition. So which of the shares price are we going to be using? Is it the one at acquisition or the one at the date of the issuing of the shares? That is the question now. Which of them are you going to be? This is not going to be affecting anything. It will only be affecting your goodwill if they are going to be asking you for impairments. But this is profit or loss. Okay, so the only time that the equity shares will have, the only thing the equity shares will affect is the what? Is the goodwill calculation. So if you don't know what to do over here, you can ignore and do your consolidation and move on. That is only going to be affecting impairment of goodwill, because you need to know the purchase consideration to find your goodwill. Okay, if you are not sure of something, please don't waste your time on it. Okay, because at the end of the day, nothing is going to come out of it. But if you are indifferent, then go ahead. But if you know that what you like, you are just trying on it, please, if you have other things to do, other things that you know to do, go and do it. But if you know that you don't have any other things to do now, but you have time in the exam hall, then waste your time on what you don't know. Okay, but if you are doing a footnote, you don't understand, move on. The footnote is not for you. Maybe after the exam hall, you'll be able to after the exam, you'll be able to adjust it. Maybe after you chatter, you might be able to adjust it. It depends. So just leave it and move on. If you see this question, you don't know what to do. You are given 2 share price, the one at acquisition date, the one after, or the one of them at the day that you are issuing the shares. Which of these share price are you using? which of them do you think you are going to, if you should be in the exam hall, which of these price are you going to be using?
I would use the one at acquisition date.
Okay, okay, okay. So yeah, someone will be using the one at acquisition date. Okay. Do you have someone who will be using the one at the date of the issuing of shares? Do you have anyone who will use that? Or we have people who we don't know, or we are part of, we don't know what we are going to be doing on that day, or the Holy Spirit will be leading us. Okay. Yes. Okay. So you see, the first answer that will come to your mind is the right answer. The remaining one that will be coming is your family people that want to destroy you. The first answer is from the Holy Spirit. The following ones are from your family, so just ignore them. Okay. We are going to be using the what? The fair value at acquisition date. Why? Because control was achieved on that particular date. So if control is achieved at a particular date and the shares have been issued later, the exchange date is still the what? The date of what? Control. Okay, the assumption is that, okay, we have agreed on everything, but maybe we have to do certain things before the shares will be given to you. So we decided to give the shares to you three months time or something. So the date that control is being achieved, that is the exchange date. So we acquire the shares one time and we gain a control of 90%. So it means that control was gained on 30th December 2018. Therefore, the exchange date is the same as the date of control. But what if control has been achieved in stages? What if control has been achieved in stages? So we have acquired 40% first. We have acquired 40% first. We have acquired 50%. So the shares will be issued at a different date. Okay, the 40% consideration, we have to calculate it by multiplying the number of shares that you are issuing on the what? On the date of this one. Then this one too, you have to also find this one by multiplying that. So if the control is achieved in stages, you also have to do your share price at each of the what? At each of the dates. But if control is being achieved at once, control is being achieved at once, please. The exchange date is the date of control. So you have to use the share price of 3 cities to what? To multiply your 1080 over there. So you might be seeing something like that. Just know that if control is being achieved at once, the exchange date is the date that control is being achieved. But if the control is achieved in stages, then you have to now find the share price for each of those dates and multiply by the share exchange to have your total purchase consideration. That is about that particular one. Any question? If there are no questions, some of us will be going to work, so I'll leave you. You go and
Hello, sir.
yes, yeah.
Please, Abego, the same question. Can you go to the C part of it and help me with how we are going to work on that? Because I was solving it yesterday.
Oh, really? Oh, really? Proud to
It's a
take you
different question. It's not the same, it's not a question, it's a different question, but it's the same thing. Just that the names were changed.
Okay. Proud to 30th September. Adam Su and other investors share control over I don't know that name. So had 60% of the Adam Su had 60% of the equity holding in this particular country acquired at the cost of 2,400 million on 30th September 2014. The nature of the joint arrangement met the definition of a joint venture. How do we account for investment in joint venture? It is accounted for as what? Investment in associate. We use equity accounting method, isn't it? Okay. Adansu, as a result, equity accounted the investment on 30th September. However, there was a disposal of the shareholding by the other investor to different what? Investors. And the resultant effect in substance granted control to Adansu over Mponsu, or at 30th September, the fair value of the 60% holding in this particular company and this one. Okay. If we decide to now do business, okay, and you are no more there, and your brother is taking over, okay, your brother will still take over in your name. So it will still be the same business that we are doing, isn't it?
Okay.
Okay. It will still be a joint venture. But just that the joint venture now, someone has someone has directed his interest to a different person, the agreement will still be a joint venture. If we establish a separate business on our own and you are no more there, and your brother is now coming, it will still be a joint venture. I'm not going to have control. Your brother will just take over from where you have stopped. The arrangement will still be the same unless we are changing and we now want to convert the joint venture into a subsidiary. Then I would be saying that I have a control. So this is still a joint venture. The business will still continue like that, but just that the other party has transferred his interest to that person. The company will still operate as a joint venture. Okay, so you don't have to consolidate. You only find your share of the profit. So the only thing that they are giving over here is the percentage that you are having. So the joint venture, you'll be taking 60% of their profit. The business will still continue as joint venture. So you're not going to be having control. All the arrangements will still be in place. Whatever you people you agreed on will still be in place. It will still, unless you want to change some of the items or you want to change everything now to make it subsidiary, then you'll be saying that you have control. Okay, apart from that, it will still be a joint venture and you still account for this using the equity accounting method. All right.
Okay, thank you.
Okay. All right, so if we don't have any other issue, thank you all for coming. I'll see you guys tomorrow. Same time, same venue. Thank you all. All right.
Thank you too, Brian. Yeah, thank you.
Thank you, sir. Bye.